Good morning. My name is Bob Balopole, and today we're going to explore some investments that have special tax advantages. Because a wise man once said, it's not how much you make, it's how much you get to keep. And I happen to come from a very heavy tax background. I was a CPA and a tax practitioner for about 17 years, and I hold a master's degree in taxation. So I bring to the table a viewpoint that most professional investors do not possess. So I'll start with companies that pay no corporate income tax, such as real estate investment trusts, business development companies, master limited partnerships, and buyout firms. And then I'll move on to talk about investments that have special tax breaks, including companies such as Berkshire Hathaway that have never paid a dividend. And I'll explain a little bit about municipal bonds, how they work, and I'll come to a thrilling close with tax-deferred annuities. So sit back and get comfortable. Real estate trusts, also known as REITs, also known as REITs, were created by Congress in 1960. Congress decided society would be better off if the real estate industry was exempted from corporate income tax. This is a huge benefit because most corporations pay a federal tax rate of 35%, and then they have to pay a state tax that could be, say, 9% or so. In order to be exempt, the REIT has to have income solely from rental income, and it has to pay out at least 90% of its taxable income to shareholders. Because of this requirement, REITs tend to pay higher than average dividends, commonly around 4%, but sometimes ranging as high as 10% or more. Now, REITs can be publicly traded just like any other stock, or they can be private. And these REITs own large portfolios of real estate, and they can be portfolios of apartment buildings, office buildings, shopping malls, even hotels, timberland, or farmland, what have you. More and more businesses are dropping their real estate into these REIT structures to get the tax break. And a primary advantage of REITs is that they can borrow at very low interest rates due to their size and their stability. This is a crucial advantage because real estate is a very capital-intensive industry. During the financial crisis, REITs had occupancy rates better than their private competitors in every market, and that was because the REITs could still access capital to fund tenant lease improvements, whereas a lot of the private landlords were shut off by their banks during that time period. So in the 16 years I have been a professional investor, I have to say that these REITs have been the most consistently excellent performers in our portfolios. Let's move on to business development companies, or BDCs. These were created by Congress in 1980 and also given an exemption from corporate income taxes on the condition that they pay 90% of their taxable income to shareholders. So like REITs, BDCs tend to pay large dividends. Our clients are currently invested in a BDC that pays a dividend actually higher than 13% per annum. And the purpose of these BDCs is to provide funding for small to medium-sized businesses, businesses up to $250 million in value. Unlike banks, BDCs can be both a lender and an equity investor. And unlike banks, which usually demand some type of property as collateral for a loan, BDCs will lend based on cash flow. In the service economy, there are very solid and successful companies that might need funding to expand, but they don't necessarily have a lot of physical assets of the type that banks demand for collateral. So BDCs fill this need. And while BDCs do employ leverage, meaning they do borrow to take in the cash that they then invest, they are far, far less leveraged than banks. And that's because there is a rule that says that their outstanding debt cannot exceed their equity. Now I'm going to move on to another category called Master Limited Partnerships, or MLPs. And again, these were created by Congress. These were created to aid the energy industry. And unlike corporations, partnerships never pay tax at the partnership level. Instead, each partner reports their share of partnership income on their own tax return. But being publicly traded would normally cause an entity, even though legally a partnership, to be taxed as a corporation. So it was this rule for which Congress created an exception for the energy industry only. So typically, a master limited partnership holds energy infrastructure such as pipelines, terminals, storage tanks, and these assets are much more reliable cash producers than, say, exploration and production assets. So energy companies can get a higher valuation by segregating these low-risk assets into a separate entity from their high-risk assets. And the fact that this entity pays no corporate tax makes the valuation even higher. However, there is a drawback to master limited partnerships, which is a turnoff to some major groups of investors. For an individual investor, investing in a master limited partnership complicates the individual's income tax return because that individual has to report the partnership's income on their own individual tax return on a Schedule E. For a non-taxable investor, such as a pension plan or a retirement account, holding a partnership interest can give rise to something the IRS calls unrelated business taxable income, or UBTI, and if a non-taxable entity has more than $1,000 per year of this unrelated business taxable income, there is a tax that needs to be paid. In our firm, we often place master limited partnerships into our clients' IRA accounts so they don't have to worry about it on their tax return. But because an IRA is a non-taxable entity, we do have to worry about this UBTI rule. Fortunately, most of these MLPs have large depreciation deductions which offset their taxable income. So normally, an MLP would not give rise to a lot of this UBTI, but you do have to study and be careful and make sure you don't run afoul of that rule. So, these MLPs often appear to trade at what I would consider bargain prices, and it's perhaps because they do have these drawbacks that turn off major classes of investors. At any rate, MLPs typically pay large distributions, 7%, 8% a year, it's not unusual, and they are geared to the investor who seeks a high cash flow. And if they need money to expand their operations, they usually take out more debt or issue more equity rather than retain the cash flow in the company, because that cash flow is more or less earmarked for the investor. Now we're going to move on to another type of investment, which are typically known as buyout firms, or what's the other name for them? Turnaround type firms. You may have heard of them. They're pretty big operations. We're talking about Blackstone Group, Carlyle Group, KKR is another one. These firms have been around for decades, structured as private partnerships, but around 2007, they all discovered some tax loopholes allowing them to become something called a passive income publicly traded partnership, which means publicly traded, they can be bought and sold on the New York Stock Exchange just like any other stock, yet they pay no income tax. However, they are still partnerships, so all those things I said about MLPs apply to them as well, namely having to report the partnership income on your own tax return and having to worry about the notorious UBTI. So these firms, what they do is they sponsor different investment partnerships in many different sectors, such as real estate or credit, and they have an enviable business model because they earn these big incentive fees if things go well, and if things don't go well, well, it's other people's money they're investing. So they have all this upside while they have little or no downside. And you may wonder, if they are so awash in money, why do they even let the public buy into their incredibly valuable franchise? I mean, these companies have a reputation that results in people practically throwing money at them, and they're limited only by the amount of good investment opportunities they can find. So why should I, Bob Balopole, be favored and be able to buy an ownership share of Blackstone Group? And the answer is being publicly traded allows these firms to use their stock as compensation for their employees, and it makes it easier for the founders to sell some of their stock and get some money off the table out of their company. But I do want to mention that some of their practices are controversial. Often they will take a public company private, fire a lot of people, and then take it public again. They call that a turnaround. So that is my list of companies that pay no corporate tax. Real estate investment trusts, business development companies, master limited partnerships, and passive income publicly traded partnerships. Next, I want to mention Warren Buffett's conglomerate, Berkshire Hathaway. Buffett likes to buy companies that pay good dividends, yet Berkshire Hathaway itself has never paid a dividend. So because of this, one can hold Berkshire Hathaway stock and look forward to the value steadily increasing due to this accumulation of earnings. Yet, the shareholder never has to pay any tax as long as you don't sell it. And if you die holding Berkshire Hathaway, then at death, the stock gets a step up in basis to fair market value at the date of death, and your heirs will have cheated the tax man. Now, there are a lot of companies that pay no dividends, but usually these are companies that are in a growth phase and don't have a lot of excess cash to distribute. Berkshire Hathaway is in a small minority of companies which reliably generate cash flow, yet do not distribute it. A final word about Berkshire Hathaway is they make a lot of money doing deals. They have a huge pot of money and they can move very quickly. So a lot of companies that are in distress go to Berkshire Hathaway. They know that's a place they can go for help. And of course, Warren Buffett is famous for driving very hard bargains, but at least you know you can save your company and get the money you need in the time you need to get it. Okay, next, we're going to talk a little bit about municipal bonds. Municipal bonds are issued by states, cities, or sometimes public entities such as school districts and what have you, and the interest they pay is exempt from federal income tax. As far as state income tax, the bond usually has to be from your state of residence in order to be exempt from state tax. So for instance, if you are a California resident, you would be exempt from California tax on a California muni bond, but not a New York muni bond. Normally, a municipal bond would pay lower interest than a treasury bond because of the tax-free feature. But nowadays, municipal bonds are actually paying higher interest than United States treasury bonds. This is an unusual aberration, and some people think it represents a once-in-a-lifetime opportunity. The last thing I want to talk about is tax-deferred annuities. The definition of an annuity is a stream of payments. And in order for an annuity to be tax-deferred, there has to be an element of life insurance involved in the product, which typically means they would offer something like a guaranteed death benefit. So when you withdraw funds from an annuity, you will be taxed on the earnings at ordinary tax rates. So many investors would be better off holding stocks and getting taxed at capital gain rates than holding an annuity and getting taxed at ordinary income rates. I am fond of a product called a life annuity, which is a product that will pay you a fixed amount every year as long as you live. So it can be a good product for addressing the risk that you're going to outlive your money. We call that longevity risk. However, the amount of payback you get is computed based on current interest rates. So with today's rates at historic lows, this may not be the best time to buy a life annuity. And if you are buying a life annuity to address this so-called longevity risk, it's smart to defer the payments of those annuities for, say, 10 or 15 years, because that's when you really need it, and put the rest of your savings somewhere else. Except for that life annuity product, I'm very skeptical about annuities, as there are a lot of deceptive marketing practices. Sometimes they'll guarantee a rate of return, and if you read the fine print, you'll find that that rate of return is only guaranteed for the first year or two, yet you'll be locked in for maybe 7 or 10 years. Sometimes they'll guarantee you'll have X amount at maturity, but then you'll find out this X amount they're promising you is only good for transfer into another one of their products, that you just can't take that X amount and use it as you wish. Sometimes they find, the annuity holders find the only way to get their money is by dying, the so-called death benefit. Finally, there's lots of fees buried in these annuities, which can make returns on variable annuities very disappointing. I would advise anyone contemplating an annuity investment to have it reviewed by some independent expert. So that is my list of tax-savvy investments. To recap, I mentioned a group of entities that pay no income tax, and those are real estate investment trusts, business development companies, master limited partnerships, and these buyout firms. And then I talked about entities that have some type of tax-free or tax-deferred feature, which would be something like Berkshire Hathaway, that pays no dividends, municipal bonds, or tax-deferred annuities. So thank you for listening, and I'm happy to take any questions you may have.